Gary Wagner is back. He is the editor of thegoldforecast.com, and we'll be talking about the Fed, his outlook on inflation and the economy, as well as gold. Welcome back to the show, Gary.
Thank you so much for having me.
Gary, let's start with gold first. Let's pull up a gold chart. I want to ask you about the recent price action. Up on the year still. However, the gold price has seen a local top around mid-July, and it has been trending down ever since. I wonder what that's been responding to. So if you look at the charts, we've had a bit of a trough. Late June, peaked around July 20th, 19th, and it's been trending down ever since. So is this downtrend a new trend, or is this just a correction from the top before we see a rebound?
Well, when I look at the chart, what sticks out more than anything else is the first part of May, when it hit the record high this year at about 2,083. From there, it had a 2 to 3 week drop. It took it to a low of about 1920. It rose briefly and went to $2,000 and then slowly traded lower, actually hitting a low of 1900 about the last week of June. From June up until about a week ago, it began to climb again, hitting a high of about 1988. Then it fell, and now it's attempting to rise again, although what we're seeing on these last two candles, this gap, has to do with the fact that this is a continuous contract of futures, and it is showing you the gap that exists as they move from August to December.
Let's compare this to the DXY. I wonder if there is some dollar strength action going on that's been making it difficult for gold to regain its May highs.
Well, when you look at the lows that it hit, June 17th, June 15th, and 14th, it came down to about 99. And from there, over a period of about 2 to 3 trading weeks, it hit this high at 102 plus. And that's where it's sitting now. So we've had tremendous dollar strength really since the middle of July.
What's been driving this dollar strength?
Market sentiment. Optimism, I believe, not very realistic optimism, that the Federal Reserve would either announce or allude to the fact that the rate hike that happened at the last FOMC meeting would be the last rate hike of the year. Originally, they had called for 2 more rate hikes this year. They implemented one as they said they would. And then when pressed to whether or not they would have another one, Chairman Powell had kind of a snarkish remark saying, we don't think that it's the time to talk about forward guidance. In other words, he didn't want to reveal that. Many traders, analysts, investors, and economists were hoping that that would be the last rate hike in this long period, going from 0 to 5.5, 5.25 to 5.5. And then what he said was that even when we do stop, it's going to maintain at an elevated level for quite some time, and do not expect a rate cut until the end of Q1, maybe Q2. And that burst the optimistic bubble, so to speak, that market participants had. The dollar strength that you're seeing was moving towards a scenario in which yields would move higher because of the change in rates.
If you zoom out, though, however, the dollar has been falling on a longer-term scale ever since mid-October or September, October 2022. And so over the last 7, 8, 9 months or so, this downward trend has been coupled with a continuous rise in the Fed funds rate. Did you find that a little bit odd that the Fed funds rate continued to go up this year, whereas the dollar saw weakness?
I found it perplexing, I guess would be the way I describe it, because the markets we're talking about have been reacting on optimism and sentiment based on wishful thinking and not what the Fed was saying. understand the Federal Reserve has been pretty adamant since they first announced their intentions at Jackson Hole, Wyoming, over a year ago. And then the December dot plot was the real news that came out that said, we're going to keep rates elevated. We're going to raise them probably to a terminal rate of 5, 5.5, maybe 6. And we are going to keep them there throughout 2023. That came before the beginning of 2023. And so it wasn't easily accepted or digested. And the bottom line is there were those, and many of those, that believed the Fed could not pull that off effectively without crashing the market or bringing on a recession.
So you don't think the DXY is somehow pricing in rate cuts anytime soon because of its downward trend?
I think that has a lot to do with it, but there's a new cog in the wheel, so to speak. And that is, when we look at dollar strength or weakness, of course, we're not talking about the buying power of the dollar. We're comparing the dollar to a basket of other currencies, 6 of them. One of them is the euro. The euro has a weight, I believe, of about 60%. So when the European Central Bank begins to raise rates, and the dollar and the U.S. Central Bank raise rates, you get this push and pull because you're comparing them to each other. The same with the Bank of Japan. I believe that has a 12% weight. So recent changes in the dollar index have as much to do with what we're seeing here locally as the fact that because we are looking at it against other currencies that are also intervening, that are also curtailing their inflation by raising rates, you've got a combination that yields the effects we're seeing. So what might seem confusing on the outward peripheral edges is not confusing when you take into account that it's comparing it to other central banks that are on the same path. Europe had higher levels of inflation than we did. And they were much slower to act. And that kind of changed over the last couple of months. And I think that is a large component in what we're witnessing.
What's your outlook then on the real interest rate? So nominal rate minus the inflation rate going into the rest of the year?
Well, right now, according to the CME's FedWatch tool, they're predicting about an 88% chance that the next FOMC, which is September, will have no rate hike. If you move out to November, it's about that. In other words, the key indicator that most professional traders look at, the FedWatch tool, is not anticipating a high probability of a rate hike. So it seems as though it's highly likely that it will stay the same, at worst, move up 0.25%. But we're not looking for any big surprises in that. The other thing is inflation is contracting. They are making real strides. And so what a lot of the confusion was recently was how come the tools the Federal Reserve used has brought inflation down, but yet they're keeping their foot heavily on the interest rate gas pedal, so to speak. They haven't let up. And that's where there's a big contention with many analysts, projection of the Fed acting in the proper way. Are they overly doing it? Are they too aggressive?
Yeah, it's interesting how the CME FedWatch tool is pricing in a lower chance of a hike by the end of the year, because if you look at core PCE, the Fed's preferred measure of inflation, it's still above 4%, which is double the Fed's 2% target. So do you think just elevated rates alone, without hiking anymore, would be enough to bring down inflation? Because essentially that's what the markets are anticipating when you think about it.
My personal opinion is, by itself, isolated, probably not. But what we do have is a whole other cog that we need to really take into it, and that is the robust jobs market right now, and the fact that the economy is running on at least 7 out of 8 cylinders. So we have strong economic scenarios, we have high wages, we have a tight workforce, and that, of course, works against inflation moving down.
So basically, what those things need to soften first before even before the Fed does anything else.
If they soften, that will be beneficial for the Fed. The Fed does not have the same kind of control on the labor force to a great degree as it does on consumer spending or consumer goods. And I think that the Fed is on the right track. I think that they will hold off raising rates unless they believe that they're seeing information suggesting an uptick or watching inflation not decline as fast as they would like.
The Fed did say, well, Jerome Powell did say several times in the last press conference and the one before that, that the Fed is going to remain data dependent. They're going to observe what's going to happen next. I wonder, Gary, people have been saying that there's a possibility of entering a stagflation scenario, which is low growth and high inflation. Now, inflation, like you said, has been coming down. I wonder if it's possible for the Federal Reserve to look at unemployment going up. I'm just describing a hypothetical scenario here. Unemployment going up, inflation remaining elevated. In that particular case, what do you think they would do?
I think they'd be more aggressive, meaning their forward guidance would look for another rate hike this year rather than taking a pause throughout the rest of the year. I think it would force their hand to continue to have a restrictive monetary policy rather than pivoting to something that was more accommodative.
If you look at the strength of the gold market over the last year, it's done very well. Now, is this signaling to you that the recession is coming, or is this just signaling to you that the gold market was responding to a weaker dollar?
I think it was responding mostly to dollar strength or weakness. There was such tremendous movement in the dollar that it had a profound effect on gold. There were many days over this last month in which we would see gold tick up $2, but when you looked at the actual numbers, it was all due to the dollar. In other words, when the dollar is weak and sellers are actually taking gold down nominally, dollar weakness will take gold and have it close in the positive, when in fact sellers were in there actively bidding it lower. And we were seeing a lot of that recently.
Yeah, that's interesting. You know, another interesting fact is that, well, you were the one who brought this to my attention several times, the fact that gold has acted as a hedge against equity volatility on several occasions throughout its price history. This is interesting because this year, the equity markets have done very well. You know, we saw this same pattern in 2020, and now again this year, gold and stocks and risk assets both moving in the same direction. Was that surprising to you?
Well, when those occurrences happened, for the most part, you had the Federal Reserve doing large quantitative easing programs. They were pumping money into the market, which is a positive factor for gold, a positive factor for U.S. equities. So typically when we saw them both moving higher, it was the response to huge sums of money being flooded into the monetary system. I think what we're seeing now that is really important and not spoken about enough is the fact that now the yields have risen over 5%. For the first time in years, I wouldn't know how many years, I know it's been a lot of them, have you been able to get the kinds of return on a CD, for example, that's 4%, a bank account 3 or 4%, bonds 4 and 5%. And so for the first time, at least since the pandemic and prior to that, you were able to get real returns on a fixed income that is considered very safe. So equities have been moving up, but as I always say, it's a stock market containing a particular group of stocks that happen to be moving, not necessarily the entire market as a whole. The tech-heavy stocks have been moving. AI has been the driver to that. But in terms of gold's effect, it's being affected by strong yields on fixed instruments because it takes the allure away from a safe haven asset that doesn't produce anything and doesn't yield interest.
That's absolutely true. So in light of current macro conditions, what is the appeal then of holding gold when you've got competing safe haven, if you want to call them safe haven assets, that are also generating a yield?
Well, there's always an appeal to having a percentage of your portfolio in gold, kind of like a rainy day fund, so to speak. I think what you're probably seeing is for those who are very, very, what we would call a positive gold bull, they're still allocating percentages of their portfolio to physical accumulation. However, that percentage has dropped and probably dropped pretty strongly, but they're still adding, just not like they were in days gone by.
Let's sum it up then. What is your outlook for the gold price into the remaining of the year? Going back to my original question, will the downtrend that we've seen since July, is that going to continue, you think?
Yeah, I think that it's all contingent upon what the Federal Reserve does. If, in fact, they do not raise rates this year, if they allude, hint, suggest in any way that they're looking at a point in time in which it would be appropriate to have a rate cut, that's going to be really the single statement that really allows gold to take off. That's what people are waiting for. If that statement is not made, which I don't believe it will be this year, maybe in December, and we'll certainly see in the dot plot for next December, but I think that gold is going to be somewhat range bound. It's got the highs near 2,000 that it needs to close above. And if it does that, it's significant because it's near the all-time record highs. It's within striking distance of 2,100, with the highs being 2,085. So with all the turmoil, with all of the pressures and factors that have been providing a bearish undertone, gold has held its own, I believe, fairly strongly.
And ultimately, what people are wondering is whether or not the Fed is correct in their soft landing outlook. Is that a scenario that you subscribe to?
It's a scenario that I can't give an answer without it being a guesstimate, honestly. The truth of the matter is, if you would have asked me 2 months ago, I would say it's impossible. The definition of a recession is to have a contracting GDP for 2 quarters in a row. I believe they've changed the definition. But whatever it is, a recession is a contracting economic scenario for an extended period of time. You can't raise interest rates without affecting it. The differential here is that the labor force is so strong and the economy is just bustling and consumer spending is running. If we do avoid a recession, it will be because of that consumer spending is high, the labor force is hot, companies are producing and selling products and services.
Jackson Hole Symposium is coming up later this summer. Do you expect any particular pivot in stance or announcements that we should be paying attention to?
And my mother used to say when she wanted something to happen, she'd say, from your mouth to God's ears. I don't think that we will hear anything to that degree unless there's data that shows that they're not only on track, but significantly close to a 2% target, that the data supports that they will reach it by a certain point in time, that they have effectively set out to lower it and have completed that. If we're still looking at 4% inflation, he can't come out and say that he's made headway because, he has. It went from 9% to 4%, but when your target's double what inflation is, how much credit can you take?
Right. Well, when you look at core PCE, a lot of that is services. Services, one could argue, inflation for services has remained hot because people are still spending money. And,
right.
Certainly you see that in the data and retail sales. Are you seeing that personally in Hawaii? Is tourism still busting there? Is people going out spending money? You see tourists from other parts of the country, around the world?
In Hawaii, tourism is our number one industry. It's our number one industry. It's what we produce to take in revenue, and it is flourishing. It is not up to days before the recession. We're still getting there. But it's certainly not a ghost town. The way I look at it is when I go into Waikiki, are there people all along the street, the walkway where the expensive stores are on Kalakala Avenue. And if you see a lot of people there and on the beaches, that tells me tourism is pretty firm. The other thing is where I live, I can see the planes that come in from the mainland because they hit a place called Ko'olina, and then they fly down the coast, and I'm further down the road, so to speak. I can't hear them, but I can see the planes turn. And there were periods last week where they were coming in every 5 minutes for hours at a time. And that tells me a lot of people are coming in. So I don't have the exact numbers, but from what I'm seeing, tourism is still strong here.
Excellent. All right. Well, where can people learn more about your work and read your technical analysis?
Thanks for asking. Daily, I do a commentary on Kitco that's called After Hours. TheGoldForecast.com is the primary place to look at our past videos. We offer a free trial, but you can sign up for our premium service. And we have a YouTube channel, The Gold Forecast. Lastly, at Gary S. Wagner is my Twitter handle.
Excellent. All right. Well, thank you very much for spending the time with us, and we'll speak again next time. Take care.
Thank you so much for having me.
Thank you for watching. Don't forget to subscribe.